Coming up, tariffs just rocked the markets, but what if consensus is wrong? We'll look at what's really driving the equity sell off. Then, manufacturing is slowing while prices are rising. Does that mean stagflation is already here? We'll break it down. Energy demand is up, oil prices are down. Why the disconnect, and what does it mean for your portfolio? Mortgage rates are falling fast, but this wasn't exactly the White House's plan. And finally, we'll decode the different types of stock orders so you can stop making rookie trading mistakes. Stick around because at the end, you'll walk away sharper, smarter, and better positioned for what's coming next. Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Rob Farian. He's the CEO and founder of Flying V, our digital marketing partner. Rob, how are you doing?
I am doing well, Gary. Closed out, obviously, Q1 before last week. So it's been nice to kind of that fresh start after the first quarter, figure out what's going on or what's going wrong, which this is going to be a very interesting 5 things. I know the markets have been crazy all over the place. People are in dire straits. It seems like in certain necks of the wood. But the rest, we're trying to figure out what exactly is going on and how it's all going to shake out. So I'm sure you're going to have a few things to say about that.
Probably.
Good to know. And this week, we're calling it the tariff issue. I'm really excited to dive into it. We're going to be talking about tariffs. And I think the one thing that sticks out that we highlighted is what if everyone is wrong? Super interesting stuff we'll get to there. We're talking about manufacturing, getting back into energy demand. As I'm sure many have seen, oil's been hit pretty hard over the last 7 to 10 days. Uranium, I know we talk about a lot on this show, same thing there. Mortgage rates, real estate, I feel like is making a strong push back into the conversation, or at least at the top of the list. And then, as always, we'll get into our 5th thing, talking about our educational topic and keeping you up to speed on everything you need to know about investing, no matter whether basic, intermediate, advanced, hopefully something for everyone here with our 5th thing. Gary, before we do get into it, I feel like these last 10 days have been a wild ride, right? What are your just general sentiments, thoughts? What questions are you kind of fielding before we do get into it? And yeah, just what's your kind of general message for everybody listening in on the 5 things?
Well, so Rob, one of the things I have done is I have changed our exposures in the deep knowledge investing portfolio. With energy prices getting crushed, we've been reacting on that. Certainly, we've made a lot of money in our market hedges. They've protected our downside in one of the biggest market downturns we've had in the last decade. And, because part of that position was in options and the VIX crossed 50 today, those positions have been tradable. And so, these have been positions where we've made huge amounts of money owning these put options very quickly. And then what I've been able to do is sell them, realize profits, take risk off the table, and then buy down, right? So buying a similar number of lower strike puts. And basically we just keep pocketing profits and rolling those hedges down. And the reason we're doing that is because it allows us to make money from this market downturn. So everybody's saying the market is terrible. The market is terrible. My response is then change your exposure, then do something different. Like we're making money from this. Right. And, somebody might say, well, wait a minute, the market keeps going down. Wouldn't you have been better off just leaving, those ever bigger and bigger hedges in place, right? As the market goes down, the value of those put options goes up. And, the answer to that is sure, that could have worked, although today we traded them really well and it wouldn't have. But, we're in a situation right now where the market skyrocketed today on false news that the president was going to delay tariff implementation by 90 days. That is 100%. It's not true. He may do it, but it certainly hasn't been announced at this point. But that moved the market, I think, like 4 or 5%, at which point the put options that were in the money would have been worth zero.
Right.
So it really is a situation where you just want to keep realizing profits on the short side quickly and then putting smaller positions back out there. On the long side, don't panic, right? Like,
Hmm.
we're doing small things around the edges, but certainly we're not going crazy. We're not panicking. A lot of the bad news that's being reported isn't real either. Like this morning, there were some very large, well respected FinX accounts. So, the former Twitter, some financial accounts that were reporting the Federal Reserve was having an unscheduled emergency meeting. And that sounded really scary, except it was a normally scheduled meeting. And these people didn't know the Fed, they meet on a regular basis. So, Rob, you sent me a question on the Discord server earlier today,
Right.
asking my thoughts on the market.
Hmm.
And it was a very hard thing to answer, simply because, you know, we were at one point down 5% today. We were up, I think,
Yeah.
the highs up 2, 3, 4%, something like that. We had these massive swings on no news, literally in the time it would have taken me to give you a thoughtful response. The market had changed and the news had changed, and half the things people are responding to didn't happen and aren't true. And so, in those situations, you know what? There's a great post up on the DKI blog that I wrote a week or two ago called "Everybody Hold On," and it talks about the emotional aspects of investing and trading, and how it's really hard. If you're losing money, it is normal to have a negative emotional reaction to that, to have your stomach up in your throat, to feel sick, to feel anxious, to feel worried or angry. And people will often trade based on those feelings. And that's a really bad idea. And so, I wrote a lengthy article for subscribers about the importance of maintaining emotional calm, about being unreactive. And the key thing is, you can't really control your emotions. And I'm not suggesting that you should. I think it's normal to have the sense of fear or anxiety or upset when you're losing money. That is a normal feeling. But I would just remind you that just because you have these feelings doesn't mean you need to act on it. Right. And we live in that world every day. Like, if every time a friend of ours annoyed us, we yelled at them, then we'd have no friends. If every time I was angry, I punched somebody in the nose, I'd be in jail. Right. Like, you can have feelings and not act on them. And I think that's a really important thing to
Yeah.
remember when you're investing.
Yeah, and I think the point from my seat, Gary, and the thing that you always remind me of is, yeah, the questions that kind of got passed through. They were, "Hey, what do we do?" And your point was also, "What do you mean? What do we do? What we should have done should have already been done," right?
Right.
Meaning,
Yeah.
hey, we had our portfolio position for this, we had our hedge positions, right? Should we see a market downturn? But your point at the core of it, hey, we're going to do what we have been doing, right? We still
Right.
like energy, right? We still like our certain positions for variety of reasons, but yeah, okay, you get some of it caught up in the wash because the entire market's down, right? There's nothing wrong with the company. There's nothing that, okay, we look at and say, wow, that's a red flag. We really need to tell DKI subscribers that we need to get out of this position. No, it's just, it's getting caught in the wash with everything else that's going on. So that's where, to your point, I think those that can be patient can analyze what's happening with the entire market, right? And seeing that, hey, this is across the board. And then, as you're saying, okay, adjusting as necessary. But again, it's case by case. It's what is your current portfolio mix look like? And those can be tough to answer, obviously, sometimes on a general basis. So I think that's where it's even more critical to tune into the 5 things each and every week, or subscribe to a premium subscription of Deep Knowledge Investing, right? Because then we'll do that for you, or Gary will do that for you, right? And yeah, he'll be able to really keep you in tune with everything
Yeah.
that's going on.
Rob, I think the points you're making are important ones. It's important to remain disciplined and to prepare in advance. So on the discipline side, our portfolio has very little tariff exposure. That's intentional. We just, it's not none, but we have
Right.
very little exposure to these kinds of issues because, President Trump made it clear. We knew last November that this was coming. And one of the things that really surprises me is how shocked everybody is. He told you, you knew in November. that this was coming. The other thing is, and you're talking about prep in advance, we had gigantic hedges in place because the market was at all-time highs and these kinds of risks were out there. And, of course, the market starts sliding and people start saying, what do we do? How do we start hedging? I'm like, you need a time machine. Like, this is you have to buy insurance before the house is on fire. It's one of those things. So, it's that kind of prep. You have to have your exposure in place on that.
Yep. Yep. Yeah, and I think that's where, as a, I'd say beginner, intermediate, right? Or for those that out there maybe in my position too, right? It's, hey, you at least are getting your portfolio in a position where, all right, it might not be 100% position the way it might need to be from, okay, setting ourselves up based on exposure. Hopefully, eventually you get it there. But okay, 4 years ago, I might have been at 30 to 40% to where, okay, now you have this downturn and it hurts a lot more. All right, it might not be perfectly positioned now, but obviously what I've learned from DKI and having different risk on, risk off factors within the portfolio helps when these types of things happen, or at least makes you feel, hey, now I've got some opportunities that I can capitalize on, right? Because you're not moving as much because you're well positioned. So, anyways, all right, let's get into it. Great discussion there. We've got a full issue where I'm sure we'll talk a lot more about this. Again, we're calling it the tariff issue. So we'll be spending a lot of time on that. That's what we're going to jump into here. Thing number one, Gary, the point you're making, or the question you're asking, excuse me, what if everyone is wrong? Curious what you have to say here, Gary. Thing number one is quite simply tariffs.
So, Rob, it's incredible to realize this, but it was only last Wednesday after the close that President Trump announced his new tariff plan. Um, it's only been,
Yeah, that is actually crazy to think about. Seems like
it
it
has
could.
only been 3 trading days, since we had Thursday, Friday, and today, Monday. So it's incredible to think about that. Now, what happened was when the president started his press conference, the market was up because the Wall Street Journal had incompletely reported that there were going to be 10% tariffs, and that was below what people were expecting. And people got really excited about that. Oh, good. It's not as bad as we thought. Well, the Wall Street Journal had it right, but not complete. There were 10% tariffs plus additional reciprocal tariffs. And as soon as he pulled out those visual aids and people saw the numbers, they realized, oh no. And the market, the equity indexes and the aftermarket trading, and I watch this stuff, religiously, went from up 2% to down 4%, literally in just a matter of minutes. Like, you watch the market crash as soon as they saw those charts. And people realized, wow, this is a lot bigger than we thought. Now, since then, the media went absolutely crazy. And, this is no surprise. They, certainly thought President Trump was wrong about everything. And the FinX community, the financial community on X, formerly Twitter, they went crazy. The free trade people were out there, banging the drum. And, people they've just lost their minds. They are angry and upset and emotional. And while I am certainly in favor of free trade, um, there are reciprocity issues here that matter. There are other issues besides just getting low cost stuff that matter. And I think a lot of the analysis that we've seen is incorrect. Last week, I wrote a lengthy piece that I posted to the DKI blog. You're welcome to go see it. I did not paywall it. I also posted the entire thing to X. It's pretty long. It's like 8 or 9 pages. And I went through my take on all of this stuff. And I went through the things that other people are looking at that I think that they're getting wrong. And so, people are complaining, understandably, about all the pain we're about to experience. And you know what, Rob? I actually think that they're right. We are going to experience some pain. And the analogy that I'd use here is when someone has a heroin addiction, detoxing is incredibly painful. And it's also necessary to save that person's life. Continuing to use heroin means today will be more comfortable at the expense of dying from the addiction in the future. And the way we ended up in this mess is we've spent the last 40 years selling off our manufacturing capacity. We've sold off our ability to make things. We export dollars and we receive goods. And in return for cheap goods, we've accumulated unpayable debt and other liabilities. So we can keep putting people on public assistance and in funding that with more inflation causing debt, but it's not going to fix the problem. And people have said, okay, wait a minute, but there's all this pain coming and it's going to take years before, if the Trump plan works, it's going to take years before people are able to build operating manufacturing plants here in the US. And, in the meantime, we're going to take pain. And why would we do this? Because we won't see the benefits for 3 or 4 or 5 years. Well, I don't know what they expected, but we've spent a good 40 or 50 years creating this problem, selling off our manufacturing capacity. We have half a century of a cheap money addiction, and changing that is going to be painful. And if it's going to take 3 or 4 or 5 years for factories to be built, do you want to start now? Or do you want to wait until the bond market cuts off our access to more debt? We then have a crash and have to build it under other people's terms and other people's timing. This is our opportunity to do it ourselves. But there's not going to be a quick, fast, painless path. And so the key thing that I would mention here is that the economy that we have, spending levels, the production we have, the lack of production we have, these are not sustainable. If we stay on our current status quo path pre-Trump tariffs, there is a 100% probability it ends in disaster. We need a different course. If people want to argue that the Trump plan isn't the right plan, okay, fair enough. But we need to be talking about doing something. The current path isn't working. And so there does need to be a course correction. Now, Rob, the piece that I wrote last week is far too long to go. I mean, we could spend an hour talking about it here. And in fact, we're going to later this week. We'll bring it up at the end of the segment. But I would just ask people to go take a look at the lengthier version of this and start to look at the arguments that people are making and see if they make sense and see if they hold up to logical, rigorous analysis. Be skeptical about what you're reading, because we certainly are.
Yeah, great point, Gary. And we encourage everybody to check that out on the DKI website. And yeah, would love any questions, comments. Please leave it either on that piece or even on this video as well for your thoughts, feedback, questions that you might have. Gary, as a follow-up to that, I mean, how does this fit with what you've been talking about, the they'll crash stocks to save bonds thesis? How does that fit into that whole discussion?
So, Rob, first of all, credit to Michael Gayed for that phrasing. He was the one who came up with, at least I think he was the one who came up with that. The first time I saw that phrasing was on his X account. They'll kill stocks to save bonds. But, here at DKI,
Michael, I apologize on that. If that comes from Michael, that's Michael. Don't come from me.
There you go. This is a topic that we've been talking about a lot here. And basically, where we are right now is because prior Treasury Secretary Janet Yellen reduced the duration on the U.S. bond portfolio. New Treasury Secretary Bessent needs to refinance $7 trillion in the next 12 months. Unless he can do so at lower rates, we're going to have an even bigger budget problem, because our interest expense is well over $1 trillion right now and could easily be $1.5 trillion this year. So, last week, the NASDAQ was down 6% on Thursday. It was down another, 5-6% on Friday. The markets have been plummeting on this, while the yield on the 10-year Treasury at one point was actually under 4%. That is a gigantic decrease. It was, I think, 4.8% in mid-January. That is a huge, huge decrease. And so, we've been telling people the Trump administration is going to intentionally try to crash the stock market, pushing money out of stocks and into bonds. Well, what happens when people buy bonds? The price of bonds go up, the implicit yield comes down, and Bessent can refinance at lower rates. This is exactly what we told you that we were going to do. So, credit to Michael for the phrasing, but this is exactly, the administration told you they were going to do this. DKI has been telling you they're going to do this, and people somehow are surprised, but here we are. The last thing I would add on this, Rob, is it's really easy to talk about the advantages of free trade. But when some of your trading partners are using mercantilist policies to grab most of those benefits of free trade for themselves, it makes sense to reset expectations. So, one of the things that happened over the weekend after we put the written version of the 5 things to bed is Israel, Vietnam, Taiwan, and then today the EU all came to the White House and said, how about zero tariffs? Maybe you'll lower. 50 countries approached the White House over the weekend to start negotiations. Rob, it's a pretty good bet that 100% of those 50 countries wanted to talk about lower tariff rates. And so, if these are our friends and our allies and our trading partners, we should be asking the question, then why did it take all of this? Why did it take threats to get them to treat us fairly? Right? And so, listen, if people want to be critical of President Trump, that's fine. Feel free. Put it in the comments. We'll read it, right? You just give us the reason, and that's fine. But, everybody seems very upset by the idea of the U.S. raising tariff rates, but everyone seems perfectly fine with the fact that our so-called friends and allies have high tariffs against us. This is something that does need to be addressed. And whether you like his policies or not, President Trump's actions are forcing countries to come to the table. And the big one today was the EU saying, we're willing to talk about 0% tariffs. Now, the one thing I do want to add here is over the weekend, I read a phenomenal piece by Alex McCrease over at Contemplations on the Tree of Woe. And Alex wrote a piece called Balanced Trade, where he actually explains the thinking behind the Trump administration's tariff policies. All the people saying they're wrong, the math is wrong, they have no plan, they're flailing. This isn't true. And Alex explains exactly what they're thinking and the formulas and how they came about the plan that they have. Now, again, you might disagree with the plan and you're entitled to do that. That is perfectly fine, but at least understand what it is. And all the people in the press saying they don't know what they're doing, it's not true. They do have a plan. You just may not like it, or in the press, they may not understand it. So what Alex and I are doing is this Thursday at 2 p.m. Eastern time, he and I are going to do a live stream discussing this issue. And we're going to focus on what exactly is going on in the Trump administration, what their thinking is on tariffs, my ideas on, how to look at the analysis other people are doing and how to see, how people are thinking about this and some aspects of the analysis here that people are getting wrong. And we're going to go through all of that. We will be live streaming to my X account. That's at Gary_Brode, BRODE. And I believe we're going to be live streaming for the first time to YouTube. For those of you who got us over 1,000 subscribers, thank you for that. Now we can live stream to you guys here. We will, of course, record it and put it up. So for those of you who can't make, the 2 p.m. Live stream, just check in later. We'll have the video posted.
Yeah, really looking forward to that, Gary, and that conversation that'll come up later this week. So be sure to subscribe. You'll get notified of when that's coming up and that live with Alex later this week. And as well, any questions, comments, tell us or rip us to shreds. Why are we wrong? We'd love to hear about it in the comments of this video. Gary, moving to thing number 2, we're talking manufacturing. We're seeing that activity is down. Manufacturing prices are up. Feel like I'm in a time warp once again. Should we be worried about stagflation? I had to check the date of this version of the 5 things. Gary, thing number 2, concerns of stagflation on the horizon. I'm going to add this in here. Here we go again.
Yeah, here we go again. So one of the economic reports I like to look at is the ISM manufacturing report. And what it does is it gives you a sense of what's happening to manufacturing prices and to manufacturing production levels. And the reason that matters is it's a precursor to consumer inflation. Obviously, if manufacturing costs are going up, you can expect to see the price of consumer goods going up a few months down the road. So that's why we take a look at it. Now, normally the manufacturing prices and production tend to move together. And if you think about it, it makes sense, right? If prices are up, wouldn't you want to manufacture more? You would produce more. Of course you would. When prices come down, your incentive to produce comes down. Well, last month we saw a really strange anomaly. And, if for those of you who can see, who looked at the written version of the five things and can see the graph, wow, there was a huge divergence. We saw a gigantic spike
Yeah.
in pricing with a substantial decrease in production. So, if you're looking at increases in pricing, more inflation, decreases in production, these are indicators of stagflation. That materializing in the US would bring not only poor inflation numbers, but potentially higher unemployment, lower overall growth. Despite what we just talked about in the prior segment, in the short term, tariffs would be likely to make this worse. Consumer confidence has been declining, but, as we pointed out last week, fortunately, our consumers have been smart. Their response to a lower level of consumer confidence has been to save and invest more. And at least that's something I think is wise. Like, our consumers are responding really intelligently to the conditions they're seeing.
Yeah, well, I mean, I think it's like just even the frustration, or even almost the groupthink aspect. That's actually correct in that. Well, everything that we've been seeing you guys do, we're gonna do the complete opposite when it comes to the government side of things. And Gary, so with that, like stagflation, I mean, we're measuring CPI, employment reports. There's eyes on GDP growth. I mean, do you believe the numbers, right?
So, yes and no. Uh, the numbers, um, I believe the ISM report, right? I believe that manufacturers are seeing higher prices and they're producing less. Um, but I do think the overall government statistics are fake. And it's something that we've been talking about here for more than a year. More than 100% of GDP growth is coming from congressional overspending. If you back out the increases in debt, it's very clear that our productive private sector is flailing. And the fact is that if the productive private economy has been in recession for a year and that's been masked by government overspending, then anything that's done to bring sanity to the situation, like Doge is trying to do and reduce spending and reduce government employment, is going to unmask that weakness that already exists. And so people are going to say, oh no, now we're in a recession. The Trump administration and Elon Musk and Doge caused the recession. No, we've been in recession for a long time. We just haven't noticed it because of government spending. For those of you who are a little confused by the way some of these formulas work, I will give you a really simple analogy. Imagine that you lost your job and you had no income, but instead of cutting back and working, instead of cutting back on your expenses and finding another job, what you did was you maxed out your credit cards and, lived an ever more expensive, more luxurious lifestyle. Well, that can be fun for a while, but that's not a really good long-term plan. And pretending that you have income when all you're doing is maxing out your credit cards is delusional and doesn't mean that you're actually being productive. That's what our government has been doing. So, is that real? No, but once people realize it, the actual economic statistics are going to look pretty bad.
Yeah, great point, Gary. Again, leave a comment, thumbs up, thumbs down. Let us know what you're thinking on this particular topic. Would love to hear what you have to say, any questions that you might have. Again, be sure to head over to deepknowledgeinvesting.com. Sign up for a free subscription. You'll be added to our free subscribers list. You'll get notified of all new content. Five Things is not gated, but a majority of the rest of the content is. We'd also love if you would subscribe or consider subscription to our premium. That would unlock all the content that you'll be receiving via those emails, current recommendations, again, insights, portfolio movements, updates, buy, sells, the whole 9 yards there. That's $100 a month. We also have discount for yearly subscription. Moving on to thing number 3, Gary, we're talking energy. I know it's been a bit rough over the last 2 weeks in the energy markets. We're seeing demand increasing, yet usage projections, oil pricing, both going the opposite direction, the inverse direction. What's going on here is what we're going to clear up. Gary, thing number 3, demand for electricity is ramping up. Projections are declining. Walk us through this. What does that mean? How does that happen?
So, Rob, power demand has been stagnant for a while. And a big part of that has been the push toward more energy efficient appliances. Now, some of those are, really bad appliances. Having a dishwasher that needs, 3 hours to do such a poor job of cleaning your dishes that you have to run it twice, that's not so great. But a lot of other appliances, refrigerators in particular, air conditioners, are much more efficient than they used to be. So as a result, in the U.S., um, growth in the 2000s, that decade, so from 2000 to 2010, was about 0.5%. In the 2010s, that next decade, 0.5%. In 2020, down 1%. Okay, well, that was the pandemic year, understood. But then the next couple of years, we saw growth in like the 0.5%, 1% range. And then all of a sudden in 2024, we saw 3% growth. And, so what are we seeing? Well, AI data centers, battery manufacturing, the electrification of everything. And boy, that has changed the energy demand curve. Now, by the way, this is something that we told you was coming. We've been saying for years that demand for energy, for electricity, is going to increase. That's going to be the case with or without AI data centers, but some of the data centers they're talking about will, they will use as much energy as an entire town or a small city. And so the last time we saw this kind of effect was in the 1970s, when consumer appliances became ubiquitous, right? At the point when I grew up, not everybody had, things like a dishwasher.
Right.
Now everyone has,
Right.
dishwashers, washers, dryers.
No, it's everything, right? Solar, it's the
Yeah.
home appliance upgrades, right? Yeah, the whole nine yards.
Plug-in cars. And by the way, the other thing that this one makes me laugh. So they came out with new restrictions on refrigerators. Hey, your refrigerator has to be more efficient. So what people did was, they had to buy new refrigerators. Well, so what everybody thought they would do is you retire the old inefficient refrigerator
I know
and you get a new
exactly what
refrigerator
you
and
mean.
your energy usage comes down. Rob, what did everyone do with their old refrigerator?
They put them in their garage.
And
Or
put what in it?
and put what? Sorry.
And put what in it?
I mean, probably beer.
Yeah, exactly. All of a sudden, the whole country learned about the joys of having a beer fridge in the garage.
Yep.
I do have beer in my fridge in the garage, and meat in the freezer in the garage. So it worked.
Yep.
But in any case, we are looking at just a huge change in demand here, and I think that trend continues.
Yeah. So, Gary, we see demand increase. It's growing for energy, but on the in the oil side, we're just seeing prices plummet. Right. I think Brent crude 81 in January to 64 as of this conversation. So what's going on there?
Yeah, actually, you know what, Rob? I'm going to take a look because yeah, here we go. Yeah, down to 64. I wanted to see where it was today. Um, so that's exactly what's happened, right? Brent crude was 81 in January, 64 now. So if energy demand is increasing, why are oil prices plummeting? And the reason for the discrepancy is that electric demand, it's a spot thing, right? People are using energy right now. But crude oil is priced off of a forward curve, and people right now are projecting a worldwide recession. I would argue that the US has been in recession. Again, we're just covering it up with excessive spending and more debt. But right now the world is projecting a recession as a result of tariffs, and energy demand always falls during recessions, and energy is priced at the margin, which is just a fancy way of saying that it's a commodity where the price responds a great deal to small changes in incremental demand. You sort of have baseline demand, small increases in demand result in huge increases in price. Small decreases in demand from that stable equilibrium result in huge decreases in price. So that's what people are projecting. For those of you who find this interesting, if you want to know if we're reducing our energy positions due to this risk, a worldwide recession, or increasing them due to last week's stock price decreases, you're welcome to subscribe. This is something that we talk about on the blog, and, changes in position sizes are, reflected in the portfolio, which is available to subscribers any day they want.
Yeah, great point there, Gary. And thanks for walking us through it. We're going to move on to thing number 4, moving into the mortgage markets. I know that's been a space too where lots of uncertainty, what's going on, commercial, residential side, both ends. You say this wasn't the intent of the White House, but they did tell us it was coming. You're going to break it down for us, Gary. And thing number 4, mortgage rates falling again.
So, Rob, recently mortgage rates peaked at over 7%. And when the St. Louis Fed updates their data, the next point is going to show a further decrease in financing costs. Um, the last reading of that was just over 6.6%. But, as we pointed out, the yield on the 10-year treasury, which the mortgage rates typically price off of that, right now it's 4.15. Within the last 24 hours, it actually, the 10-year traded at a 3.9% yield. So, we're going to see mortgage costs coming down. Typically, when mortgage rates rise, property prices fall so that people have similar monthly payments, right? Like, you can afford a certain payment, whether that payment goes to paying principal or paying interest expense. People, they care, they should care, but for a lot of people, they really just care about the monthly payment. And I understand that. So the hope is that, when mortgage rates rise, property prices would fall. That isn't what happened the last time around. What happened was when the Fed raised rates and the bond market moved with that, and we saw the 10-year go from, basically we saw mortgage rates go from under 3% to over 7%. You would have expected property prices to fall. They didn't. And the reason for that is because so many people that had these advantageous 3% mortgages said, well, there's no way I'm selling my house now and buying a new house where I'm going to have to get a new mortgage at a much higher rate. And people were in this really weird situation where they could have sold a large, expensive home, bought a smaller, less expensive home, but because the mortgage rate was higher, had higher monthly payments. Nobody's signing up to do that. So the question is, will we see a reverse of that this time around? And, normally you would expect that lower mortgage rates, easier financing would lead to higher home prices. This is how you blow up an asset bubble. In this case, what it may do if rates come down another 50 or 100, 150 basis points, something in that range, is it may actually free up supply. It may be enough to get people to say, okay, I'll put my house on the market and, move and take the risk of getting a new market rate mortgage. And so it actually could put more supply on the market and reduce home prices. It would be counterintuitive, but in this situation, it's actually something that we would expect.
Yeah, it's interesting. I think a lot of people my age are kind of in that same boat. I know we are too, even personally locked in with the low rate, but then it's like, okay, the jump into something that's bigger. Yes, we would need it, but you're just buying a lot less house. But we've been actually actively looking and kind of seeing the same things, right? Starting to see a lot more supply, stuff sitting, even the consideration to throw offers far below asking, just to see, what type of bite you might get. And I think it's only going to shake out more and more as we move into the summer and towards the end of the year. Gary, circling back to the first point leading into this, I mean, wasn't this what the White House told us was going to happen?
Yeah. I mean, the fact, again, to quote Michael Guyed, we've been telling you that they were going to kill equities to save bonds. And so I don't think that the Trump administration was doing this in relation to the housing market. I think, that the plan, let's just take a step back. In his first term, President Trump used a rising stock market as a report card on his presidency. This time around, right, tariff discussions and announcements have caused equity indexes to fall. And the president's flat out said he's not concerned about the stock market. He repeated that again over the weekend. This is a situation where the White House is making it explicitly clear they will take down stock prices in order to push money out of the equity markets into the bond market and reduce yields on the 10-year treasury, and allow Besant to refinance. Again, he's got to refinance $7 trillion. So I don't think the Trump administration was aiming at housing prices. But again, we told you this would happen. The White House told you this would happen. This is exactly where we are on this. And the one thing that is a positive, Rob, for people like you, is I think a lot of young people have been unfortunately priced out of the housing market by, just a combination of underbuilding, really high prices, higher mortgage rates. Houses are just really unaffordable for young people, and it's delaying family formation. People are afraid to have kids. They feel like they can't afford it. None of that's really good for society. So, even as a homeowner myself, I can certainly see the value of more affordable home prices for people. And, that may not be great for me, but I think it's probably good for the country. And I think being in a situation where young people feel like they can't afford to get married or
Uh,
start a relationship or start a family or have kids or own a home, it makes them feel isolated and locked out of the system. And at this point, we got a whole generation of people who feel unfairly locked out of the system. And certain things are their fault, but this one is not.
uh,
Certain things are choices that people or groups of people or individuals make. This one is not on them, right? This one belongs to the Federal Reserve. And
yeah,
so, and Congress as well
yeah,
for overspending.
yep,
So, I think that's where the blame on this one lands. And, I think, again, President Trump is trying to get rates down so that they can refinance the debt. But there could be benefits for young people who want to own homes here, and that would not be a bad thing.
yeah,
And for people who find this interesting, let us know. If you're watching this and you did buy a house recently, or you're thinking about buying a house, or you tried to buy a house and it fell through because you couldn't get mortgage financing, whatever it is, I'd be interested in your stories. Maybe put something in the comments. I'd like to know what kind of experiences DKI viewers are having with this. It'd be interesting to see if you're comfortable writing in.
yeah. Yeah, I think definitely would be interesting to hear what everybody has to say. I think even personally for me, I've been thinking about this a lot. And Gary, I mentioned to you, we've been looking at commercial spaces, right? Because I mean, the commercial
Yeah.
spots, and we've been talking about it forever, have just been absolutely hammered, and they're so suppressed from a pricing standpoint. And with us here in Southern California, obviously market pricing is, it's always you're okay making that bet just based on the location, right? And where you are, and okay, you're looking long term more often than not. But then I also thought about it too, and like, hey, who are the impressive people that we're bringing into the company that are really excited about what's going on? And it's always the young people, right? Like whether college interns, entry level, looking to really get up and going with their career. And I think you nailed it, they've physically been isolated, right? In the sense of, hey, everyone stay home over the last 4 years, work remote, suppress creativity, don't communicate in person. And so we've actually been thinking of it the other direction as like, hey, this is creating actual opportunity to bring along the young generation, to get them, back involved in community and being around people and building stuff, right? Which I think a lot of that has been lost, but I think a lot of that is looking to be injected back into the American economy and manufacturing and building here and promoting our young people who I think have really been failed by the system over the last 4 8 years, probably even going back on a decade and further, depending on how long you wanted to take the argument.
Rob, I think you make a really interesting point. And, I'm a couple decades older than you are, and it's really interesting to see the way the two of us are going in opposite directions on this. And it's different from the narrative that people typically have, right? So the narrative we've seen over the last few years is all of the senior people, all of the Gen X and boomers are, saying to your young people, to their young people, you have to be in the office. You have to be in the office. I want you back in the office. And, the narrative has been that the young people are saying, no, commuting is stupid. It's a waste of time. I don't want to do it. I can work from anywhere. I want to work from home or wherever I am. And they've been fighting that and saying, I don't want to return to the office. And what's really interesting is at Flying V, you're seeing the advantage of having a nice office that brings people in and creates that community. Now, a generation older than you, I refuse to have an office. And, one of the things we disclosed here a couple of weeks ago is I've made an agreement. I've signed a contract to rent out my house for a year starting May 1st. And I'm going to spend the next year working from everywhere but here. I work from all over the world and work virtually. And it's really interesting to see the two different directions we're taking. And then earlier today, I got an email from an organization that tries to place young interns. And they sent me something saying, hey, look at these 3 or 4 or 5 young interns. Would you consider taking any of them on? And I scrolled through, and the thing that jumped out at me, Rob, is every single one of them said these young people said they would only accept an internship if they could be in the office a minimum of 3 days a week. They wouldn't accept a virtual internship. They were like, I will only do this if I can be in the office 3 to 5 days. So I'm thinking, well, I'm going to be working from South America, Central America, Europe, maybe part of the Middle East. I'm going to be all over the place. I couldn't take any of these people even if I wanted to.
Yeah.
Right. And so it's really interesting to see younger people saying, well, we only want to accept a job if we're going to be in the office.
Yeah. And I mean, I think it's a fascinating dynamic because if you think about it, the college experience for a lot of those that are now moving into the workforce, where we are seeing the best benefits is 2 things. They know social media and they also know AI, or they're at least not afraid of it and they see the exact benefits of it, or they're somewhat already familiar with it. Right. But they've been robbed of that community or even that pipeline to then get them into that next phase. And they've already said, I've already been sitting in my room for the last 4 years. I don't want to be doing that any longer. Right. And so now I think it's like, okay, myself as a local business owner, like, all right, well, let's lean into that. Let's create a space where, people are excited to come. They want to feel a part of something. They want to build and create, because I think it really has just been a generational shift that has happened, I think, more or less synthetically, right? And now we're kind of seeing what that has created. And the younger generation, for as bad of a rap that they're getting, they're pushing back, like you're saying, and saying, no, like, you guys had all these, cool experiences, places to travel, meeting people in person, going to lunches, working in the nice offices, and now I'm just supposed to work from my basement and I have no upward mobility, and I'm not seen, I'm not heard from, I'm not having hands on with real interactions, real business and things that are happening, right? And I think that's what you're seeing, and what's crazy is it's happening like this, right?
Yeah.
In what before would take months to kind of move the market, it's happening almost overnight, which has been wild.
Yeah, it does feel like there's been, to use their vernacular, an instant vibe shift.
Yeah.
That generation of people in their 20s went from, you can't make me come back, to, I won't take a job unless I have somewhere to go. Now, now listen, part of it from a career development point of view, I do see their point of view. Part of it, that it's partly on them as well. Like earlier this year, Rob, to your great discomfort, I was working from Thailand, Vietnam, Korea. Over the next year, I'll be working from El Salvador and Nicaragua, Guatemala, Portugal. Like, if you don't like working from your basement, then go somewhere. And those options are available. If you're not happy with your circumstances, like, they don't have to sit at home. They could be adventurous. They could work from anywhere. In fact, you know what? A guy I want to give credit to, somebody who is a huge contributor to the 5 things, DKI intern Cash and Crow, who did a great job on this week's 5 things. One of the things I'd love to see about Cash, and personally, professionally, he's advancing really quickly, but personally, he travels a lot and is willing to get on a plane and go somewhere on his own, just like I do. Like, I'll meet people there. It'll be fine. I'll have interesting experiences. Like, he just buys himself a plane ticket, finds a place to stay, and goes. And I think that's phenomenal. I love to see that about him. So people have every right to want to be in an office, but if you're complaining because you don't like working from home, then go work from somewhere more interesting.
Yeah, and I think that's where too the business owner's side, I think, you're seeing that dynamic that is shifting though back to heavier weighting on the value. We're getting down a tangent, but this is great. Like heavy value on the creative or actually the in-person aspect of the business too, right? Because so much of what you had to be in person to actually create before and took a lot of time, energy, and effort is now being done by automation, right? But the elements that are missing are that human element that,
Yeah.
is a lot easier to do in person, right? And I think that's what you're saying. So, all right. Anyways, we could talk all night on this.
Moving
We're
on.
gonna move to thing number 5. Maybe we'll put that on the back burner for a follow up edition of the 5 things. This is the tariff issue. We're gonna get into our educational topic, Gary. Today we're gonna talk about the different types of stock orders. So that's thing number 5. Gary, let's start, and then I'm gonna ask you on specific type of orders. But let's start. Why is this important to understand? Why do we need to be aware of the different types of stock orders that exist and their use cases?
So, big picture, Rob, is it has to do with control, right? People have this idea that, oh, well, you just go buy stock and they don't really know what they're doing. And, one of the things, for better or worse, that the app Robinhood did was they made it really easy for people to trade. But the downside is people don't always know what they do and don't have control over. And so there are certain kinds of orders that will allow you to control time, others that will allow you to control stock prices, others that are contingent on other things. And so you use these different kinds of orders to control risk and prevent a really bad outcome. Because listen, if you're trying to buy $1,000 of stock and it's something that trades huge amounts like Apple or Nvidia, well, then it doesn't much matter what you do, you'll just get filled. um but if you're a larger account, if you have a larger account and you might be trying to buy something that's maybe less liquid, or a lot of people, I don't recommend this, but a lot of people are trading options. Those are less liquid. And so having more control over your order and understanding the kinds of risks that you're taking with each different kind of order, I think is something that matters.
Yeah, no doubt. Gary, we're going to get into each of the different types of orders. So, Gary, let's start with limit order. What is it? How does it work?
All right. So a limit order is an order that would be executed at a price that you specify or better. So imagine, you want to buy a stock, XYZ, and, the stock is trading at, $99.50. And, you don't want to pay more than $100. And so you could put in an order that says, I'll buy this stock, but not if the price goes up too much. Alternatively, maybe that XYZ stock, is coming down and you're looking at it and saying, well, I would buy this if it gets to 95. I'm just making up numbers here, right? And in that situation, you could put in a limit order that would instruct your trading software to only buy the stock if you can get it at 95 or below, right? And so I use that a lot. Like earlier today, I saw a stock that I really like. It was trading down and I put in an order way below the market. I'm like, listen, if this thing crashes in the illiquid pre-market, I'm going to pick up stock, because I knew once the market opened, it would recover once there was volume. And that is what happened. Um, but here's the quick and easy way to think about it. With a limit order, you have control over cost, but not your execution timing, right? Your order controls your cost, but when it comes to the timing will be whenever the stock trades at the level that you want, right? And so limit order, you control cost, but not the timing.
Gary, real quick, how long can you keep a limit order open generally?
So in now, this answer will depend on your trading system. This is not a general answer. This is not trading advice, really important. Um, Generally, in most systems, if you put a limit order in and it is not filled by the 4 p.m. close, then the order will expire. You can put in a good indefinitely. There is a place where you can check something that says, leave this order open indefinitely and, just have it filled. Now, I never, never, never do that. You could, But I don't do it for two reasons. One, there is always the slight possibility that you might forget, right? You got an order in, but you forget and you use capital for something else, and maybe that order gets executed and now you have a margin call, right? You're using too much capital, or your exposures are not what you wanted them to be. It's possible to forget. More than that, and this is the key thing, let's say you put in an order saying, well, I would buy XYZ if the stock gets to 95. And that's based on the conditions that exist that day. But what have we seen, Rob, over the last 3 trading days? We've seen some stocks get hammered 20, 30, 40% in 3 days on news. Now, I don't think the tariff stuff is nearly as horrible as many people are making it out to be, but it doesn't matter, right? The point is, there could be things that happen that would change your idea. And, if you were to put in, like, again, the hypothetical $95 limit order on, XYZ stock, if there's news on it 3 weeks down the road and you could get filled at 95 when it's on its way down to 75 or 65.
Yeah.
Right. So these things can happen. So you can leave a limit order outstanding for as long as you want, but I would be very cautious before doing that. And it's not something, let's just say it's not something I've ever done before.
Great. Gary, moving forward, we'll go some rapid fire. Tell us about market order. What is it? How does that work?
All right. So a market order is basically the opposite of a limit order. You're going to have control over the timing, but not the price. What happens with a market order is you just send an order to the market that says, I want to buy, 100 shares of NVIDIA now. Just go buy it, whatever the price is. And most of the time, if you have a liquid stock and you're not trying to buy too much of it, a market order is fine. The reason I don't use market orders that much is because there are really rare situations where liquidity has just disappeared instantly. And people have put in market orders thinking that they were going to be filled at a reasonable price. Liquidity disappeared and they ended up getting filled at insane prices, like double the price that they expected. Or if they're selling, half the price they expected. It's not something that happens often. But in my opinion, unless you're trying to trade huge amounts of stock, there's just no reason to take that risk. And in my situation, I prefer to set a price that makes sense to me rather than just let it go. The situations where you would use a market order are ones where it's a really liquid security and you want it done immediately. Sometimes, like, maybe I'm making this up. Maybe it's like 359 on a Friday. You really want to own this thing over the weekend. You think there's news coming. That's a situation where you just click market order and you get it done instantly, rather than, waiting and being stuck, not being able to buy it until Monday.
Got it. Gary, market on close order, MOC.
So that is an order that gets executed as a market order at the end of the trading day. And the idea is that the price will be at or very close to the closing price. The reason you would do that is because when people mark their books, they mark at the closing price. So let me give you an example, right? Rob, imagine a situation. So we're using this hypothetical stock XYZ, right? And, let's say that 1 million shares trade during the day. And, that stock is right around $100. And so $1 million trades between 99.5 and, 101. And so all of that trading takes place there. And then at the end of the day, the last trade takes place at $90, right? What that means is that even though the stock was trading at or around or above 100 all day, when it gets marked to market, it will be marked at the price at 4 p.m. And so, people often will want to have a price that reflects the closing price. That's when you would use something like that.
Makes sense. Gary, moving forward, we've got an all or nothing, also known as fill or kill. What type of order there, Gary?
Yeah, all or nothing, AON, fill or kill, FOK. Rob, how would you pronounce that? Never mind. That's an order that would be executed only
it
if
depends in which context, right?
Exactly. Is it a buy order or a sell order?
Yeah, yeah. How am I feeling about it?
Yeah, that's FOK. You know what? If you know how to pronounce that, put that in the comments, please. Just let me
Yes.
know. We're curious. We're
Yes.
not really
Yes.
sure.
Exactly. Exactly.
That's an FOK order, fill or
That's
kill.
right. That's right.
Um, anyway, that order only gets executed if the entire order can be filled immediately. So you would use that typically if you're bidding on multiple exchanges or trying to set up a pair trade. So in the example that we just gave, say you want to buy 100 shares of our, XYZ at, 99 and a half. That order will only be executed if you can buy 100 shares right away at that price. If it's only going to be a partial fill, it won't buy anything for you.
Got it. Okay. Thank you for breaking that down, Gary. We got a couple more here. Bear with us. Volume weighted average price, Gary. What type of order is that? Tell us more.
Yeah, volume weighted average price, otherwise known as the VWAP. That actually is how it's pronounced. Uh, yeah.
Yeah. Are you sure?
No. Anyway, that's an order that it tries to match the average volume weighted price during the trading day, right? So the way you'd calculate that is if you take the total dollar value of the stock in that particular security that's traded that day, divided by the total number of shares traded, you'd end up with the volume weighted average price. And it's a way to match the average market price for a whole day. The reason you would do this is, let's say the stock is really volatile. You're not sure. Should I buy it now? Should I buy it, closer to the close? Should I buy it in the first 15 minutes of trading? I don't know. Is it going to go up or down? Like sometimes stocks are really volatile and people don't want to have to pick, a moment. And by the way, one of the stocks that I look at today traded in a range of 450 to 650. That is a more than 40% range between the low and the high trade of the day. So if you're dealing with a security like that, you might just say, you know what? I don't want to deal with the trading and figure out, like, am I buying at 450? Am I buying at 6? Am I buying at 625? Am I buying at 5? Like, who knows? And so what people will do in that situation is just say, you know what? Just give me the volume weighted average price. And you enter that order and then you just let it run all day. And, fingers crossed, the algorithms tend to be pretty good. Obviously, there's no guarantee, but they tend to get you pretty close to the target.
Gary, and finally, the pairs trade, our last order.
Yeah, that's a conditional order. And what it does is you can think about a pairs trade one of two ways. One is you would execute two separate orders at the same time. You would do that, like, for instance, useful for risk arbitrage, something I used to do. Where investors will be buying one security and selling another at the same time, hoping to profit when the spread between them collapses. So what you do is you would say, okay, buy me however many shares of XYZ, and at the same time, sell me, this many shares of ABC. And they get executed together. And that way you maintain that relationship, right? Between the number of shares of one that you want to own and the number of shares of the other that you want to be short. So it's a merger arbitrage strategy. The other thing you can do with a conditional trade is you can set conditions in one security to cause a trade in another. So like the example that I used in the written version of the 5 things, I put up a trading box showing what an order entry looks like. So you could say, if Nvidia trades at more than a certain price, sell my Microsoft position, right? And so somebody might say, well, wait, why would you want to do that? And the answer might be because you might want to only have a certain amount of exposure to the mega cap tech stocks. So, if you have a big position in Nvidia and it goes from, a certain percent to another, it's grown, you might say, well, I want to reduce my exposure. I don't want to own, this much exposure. And so, well, I don't necessarily want to sell Nvidia. What would I do? I'd want to sell Microsoft or Apple or, one of these other, or Amazon. So you can set up a conditional order where a change in the price of one security causes a trade in a different security. So these aren't the only kinds of orders that can be entered, but it's a pretty good description of the ones that you, as basically, if you don't know about these are the ones you need. If you do know about them, then you have your own trading system and you didn't need to watch the segment. But thanks for being here for us. We appreciate it.
Yeah, no doubt, no doubt. Gary, any final kind of takeaways for you, from you, excuse me, to listeners? What would be kind of that one key takeaway just about order types from you?
Yeah. So look, you have your choices. And the thing that I tried to do in our description is to give you a sense of the benefits and risks of every one of these kinds of trades. What I would suggest for most of you, unless you're dealing with really unusual circumstances, most of the time I use limit orders. And the reason I do that is just to prevent the, 1 in a million possibility that the stock price could move a lot while the order is being executed. Now, somebody might say, well, wait a minute, but if I do that, I may not get filled. The stock is moving. How do I do that? And the way that you can use a combination limit and market order to ensure that you get executed, but not at an idiotic price, is what you can do is you can use a limit order. Let's say you're buying, but you can set the price that you're willing to pay above the offered price. Right. And so like in the example we're using, if XYZ is trading at 99.5, you might say I'm willing to pay up to $101. And you'll probably get executed before the stock moves that much. But it's a way of ensuring that you get executed or filled immediately without running the risk that you end up, paying a $200 or $300 price. Again, that doesn't happen often, but you don't want it to happen to you.
Yeah, no doubt. Great stuff there, Gary. Thanks for breaking all of that down. Please, by all means, head to deepknowledgeinvesting.com. Use the Ask Gary feature. If you have any questions about investing, just really anything that comes to mind, might even make it on an episode of The Five Things. So be sure to head to deepknowledgeinvesting.com and use that Ask Gary feature. That concludes this week's version of The Five Things. No, we ran a little bit long this week, but great conversation, lots going on. I think it was definitely due. This was the tariff issue. Please head to our website, deepknowledgeinvesting.com. Sign up for a free subscription. We'd love if you'd consider a premium subscription at $100 per month, access to the entire portfolio, no gated content, the whole 9 yards there. Special attention from Gary. We'll even throw that into the mix as well. But more than anything, thank you for watching here. Please like, comment, subscribe. Tell us how bad we are. We'd love to hear that too. That's always the most fun. And now, Gary, I'm going to turn it over to you for final closing thoughts on this week's version of The Five Things, the tariff issue, or this week's issue.
So, Rob, first I want to thank the DKI premium subscribers who have been pinging me constantly over the last week with really good, smart, calm questions. These people have nerves of steel like me. They are not emotional traders. They're cerebral and, just really smart investors. It's a great community we have there. But people are curious, and I've been getting a ton of really great questions. Nobody's panicking. Nobody's panicking out of their positions. People understand that they have to deal with some market volatility, but the interaction there that we've been having has been terrific. We've gotten a lot of questions that have turned into really good blog posts. Credit again for this week's episode, Cash and Crow, DKI intern, did a fantastic job. We just brought in a new analyst, Matt Pettit from the London Business School. He's an MBA student there who has shown some real promise as a stock picker. He's going to be working with me on the portfolio. Really excited about that. Finally, we want to invite everybody this Thursday, this Thursday at 2 p.m. Eastern Time. Alex Macris from the Contemplations on the Tree of Woe blog, and I and Matt Pettit, we will be talking about tariffs, focusing on what's really going on and what we think other people are missing in their analysis and hysteria about it. So it should be an interesting conversation. We'd love to have you watch live. If not, come check it out. It'll be posted immediately. Finally, for those of you watching this extra long edition of the Five Things and the tariff conversations, what's that?
I said, well done to them.
Yeah, right. Thank you. Look, we know your time is valuable. Thank you for spending it with us. You are more than welcome to like and subscribe. But hey, we're not the boss. You do whatever you want. And that's the story. And Rob, always great filming this with you. everyone, please tune in on Thursday, and then we will be back next Monday with a new version of the 5 things. Who knows what's going to happen this week? It's the only thing I know is that a lot's already happened already this week, and it's only Monday. So, tune in. We have no idea what's going to happen between now and then. Looking forward to it.
Thanks, everyone.